Welcome everyone. Today we're breaking down the 2023 federal budget. I'm Jason DeBoer, coming to you from the BDO Melbourne office, and it's great to be your host today. It is no secret that the last meaningful tax reform package enacted in Australia was the introduction of the GST in June 1999, nearly 25 years ago. Once again, the government has missed an opportunity to use its mandate to deliver productivity-enhancing tax reform, preferring to tinker around the edges and push the issue down the road. Today, we look at Tuesday night's budget in detail and ask, if not now, when? Today, I'm hosting this webinar on the land of the Wurundjeri people of the Eora Nation, who are the traditional custodians. I pay my respects to their elders, both past and present, and also acknowledge the traditional custodians of the different lands you each join us from today. To start, you will see that you are automatically muted. We welcome your questions throughout the session, and please submit these using the Questions tab. If you are having technology problems, click the support button at the bottom of your screen. As is customary, this session is being recorded. You'll get the slides afterwards via email, as well as contact details for each of your speakers today. Let me now introduce you to our wonderful panel of BDO experts. Ali Flint is a partner in the Project and Infrastructure Advisory team. She's an industry leader in regional economics, land use modelling, and demand forecasting. David Blake is a Melbourne tax partner with over 30 years of experience in corporate and international tax across a range of industries. James Traynor is a tax partner in the Sydney office with over 20 years experience providing employment tax services to a range of public, private, and not-for-profit clients. And Shirley Schaefer leads our superannuation team from South Australia. She's a recognised industry expert and is a passionate advocate of her clients, her team, and her industry. Now, Ali, I'll hand over to you.
Thank you, Jason, for that warm welcome, and good morning, everyone. Today, I'll be talking to you about the economic outlook that was delivered in Tuesday's budget. The macroeconomic backdrop for this budget is challenging, with a significant amount of global volatility. There are signs that recent inflationary pressures, both in Australia and globally, have peaked. However, the return to inflation to within the 2 to 3% target band is still not expected to happen until 2 years from now. Across the world, central banks, including the Reserve Bank of Australia, have raised official interest rates aggressively. However, what the full impact of these rate rises will be on economic growth has yet to emerge. At the core of Tuesday's budget was the $14.6 billion cost of living relief package aimed at helping households and small businesses make ends meet at a time when inflation and interest rates remain high. More broadly, I think the budget may add to inflation, but not in a materially significant way so as to impact the outlook that has been set out in the budget. Of course, the injection of spending could prompt the Reserve Bank to raise cash rates past the 3.85%, which it is currently sitting at. The cost of living package includes savings on energy bills, cheaper medicines, a modest increase to job seeker and rent assistance. The overall budget position has improved from the October budget, with savings on interest costs in the NDIS shifting the budget position closer towards balance over the next decade. Inflation, of course, has been at the forefront of everyone's mind for the larger part of the last year, and this budget assumes that it has peaked in December of last year at a high of 7.8%. The Treasurer has claimed that the measures in the budget will not increase inflation, with inflation returning to the Reserve Bank target band in the 2024-25 financial year. So price pressures, unfortunately, will continue to weigh on households and the broader economy for a bit longer than we would like. Nominal wage growth has picked up and is expected to build to a peak at 4% in the next financial year, which is the fastest pace of growth since 2009. The combination of faster wages growth and lowering inflation is expected to see an earlier and stronger return to real wages growth in early 2024, which effectively means more buying power, which is good news. Increases in tax revenue and a comparatively small increase in spending has underpinned the turnaround in fiscal outlook from October's budget. Our economy has outperformed Treasury forecasts from last October and added an estimated $135 billion in revenue in this financial year and the following 4 years through a surge in both company tax and personal income tax. So the underlying cash deficit is now forecast surplus of $4.2 billion in this financial year, but the budget does return to the red over the next few years, with the cumulative underlying cash deficit forecast to be $126 billion lower over the next 5 years. The main driver of the government's unexpected return to surplus is a large increase in Australia's nominal GDP, which has been revised upwards from the October budget and which is not adjusted for inflation. So real GDP growth is expected to be slower at 1.5% in the next financial year before recovering the following year, which is unchanged from the October budget forecasts. In relation to the labour market conditions have pushed Treasury's projections of a 4.5% unemployment rate back to the 2024-25 financial year. So that's pushed it out from a current rate of 3.5%. The unemployment rate will still remain lower than both pre-pandemic and historical levels. The resilience of labour demand means that the eventual rise in the unemployment rate is expected to be more gradual and peak slightly later than what was expected in the October budget. We're also expecting more population growth. It's now expected to be 2% in this financial year and 1.7% in the following financial year, which is a substantial upgrade from the October budget. Now, the biggest driver of this is net overseas migration, which is forecast to be a whopping 400,000 people in this financial year and 315,000 in the following financial year, which represents quite a catch-up from the border closures during the pandemic, where we had zero migration. The strength in migration and population growth is expected to be temporary, though, with forecasts expected to largely return to normal patterns, albeit slightly higher than historical from 2024-25 financial year. There's no doubt that elevated inflation, current negative wage growth, and the Reserve Bank's rapid tightening cycle are causing financial pain for many households and small businesses. And this budget was critical to strike the balance between the targeted cost of living relief and making sure fiscal policy is helping rather than hindering the work of the central bank. I think at its centre, the government's cost of living relief package largely strikes this balance, although the fact that policy decisions are going to add another $14 billion to spending in the next financial year may make the Reserve Bank's task slightly more difficult than it otherwise would have been. The unexpected return to surplus and improved medium-term outlook does create a risk of complacency and perhaps a delay in the big decisions that might be needed to place the budget on a stronger longer-term footing and increase productivity growth. Back to you, Jason.
Thanks, Ali. I think understanding the economic context of the budget and budget measures is pretty crucial in us understanding the measures and assessing the budget overall. So thank you very much for that, that summary. Before I get into the corporate tax measures, I've identified 4 themes that I think come through from this budget. Firstly, there is a continuing focus on multinational enterprises and making sure that they pay the right amount of tax. There's a continuing focus on revenue from compliance task forces, and we'll get to those. There's a continuing avoidance of structural change. Jason made the point in his introduction that we haven't had any significant structural change since the 2000s, and I think there is a general want to avoid large-scale structural change, and I think it's needed, but unfortunately governments of all persuasions have avoided that. The 4th theme is that there are a series of short-term proposals that are largely introduced to try and deal with some of the issues that Ali was referring to: population growth, She didn't directly refer to housing affordability, but there's a series of these short-term proposals. Unfortunately, my assessment would be that they don't appear to be part of an integrated policy approach, and therefore I think that there's some serious issues around that. The Age in Melbourne called the budget measured but timid. I'd like to add a sense of irony that I got out of the budget, and I'll explain those as we go through the measures. So to multinationals first, and there are a series of pre-budget changes that I think are appropriate to refer to in this presentation as well. The first was a change to the thin capitalisation rules. Up until this year, well, up until the announced changes that are coming through, thin capitalisation was based on a balance sheet approach. The decision has been made that there will be a new earnings-based approach to determining how much interest foreign-controlled Australian companies are allowed to claim. So there are essentially two methods. Whilst there's really three, but there's essentially two. First is an earnings-based fixed ratio test, which basically says that provided the total amount of interest is not more than 30% of a tax-adjusted EBITDA, then your interest is allowable. The excess is not allowable, but can be carried forward. The second more popular test that might be used will be the external third-party test, which basically replaces an arm's length debt test and says if you can take a deduction for all of the interest on external debt, regardless of whether it passes the fixed ratio test or not, but you cannot take any deduction in relation to any related party debt. So it'll be interesting to see how that one pans out. These changes largely reflect a policy approach that was first adopted in Germany during the financial crisis in 2008. A change that was then picked up in France and then more generally picked up throughout Europe. And in the early period of the Trump presidency in the US, they similarly moved to a fixed ratio EBIT-based test. So this is not an unusual approach. The only thing that I would suggest is that it is unusual in the context of Australia because we are such a huge capital importer, and unlike those other countries that I referred to, which might tend to be regarded as capital exporters, it's a bit of a difference for us. One of the things that did come as a bit of a surprise was the removal of deductions for NAIN income. NAIN means non-assessable, non-exempt income. So if you've got an offshore subsidiary that you fund with debt, any dividends that you would have received from that subsidiary are non-assessable, non-exempt, but you're able to still claim a tax deduction on any interest that you borrowed to fund the subsidiary. That capacity is being removed, and that is a surprising change. I think we can go to the next slide, please. Another of the multinational tax integrity measures that was introduced pre-budget was a proposal to deny deductions for payments made by significant global entities. So these are companies or groups that have more than $1 billion worth of worldwide income, in relation to payments that they make for the exploitation of intangible assets where the recipient is sitting in a low tax jurisdiction. There's a bit of a theme going through a lot of changes involving multinationals that basically says if the payment is going to a low tax jurisdiction, then you're not paying your appropriate share of tax in Australia, and there's a global push towards having multinationals pay their appropriate share in their jurisdictions that they operate in, and this is just one of those additional measures. This one applies from 1 July 2003, whereas the thin cap measures that I referred to earlier apply a year later. On budget night, we were advised of another change to deal with multinational tax integrity, and that is some changes to Part 4A. The two changes are that Part 4A will be extended to schemes that access lower Australian withholding tax rates on income that are paid to foreign residents, and the second extension is to schemes where the dominant purpose is to reduce foreign income tax, but also results in an Australian tax benefit. For many, many years, large multinationals who undertake tax arrangements have been able to suggest that the dominant force of, well, the dominant reason that they were doing what they were doing was to avoid tax in a jurisdiction other than Australia, and therefore the argument went that Part 4A didn't apply because the dominant purpose wasn't to receive an Australian tax benefit. Part 4A is to be changed to take that argument off the table. There's a couple of things about this. One is that there's not a lot of detail, but one can only assume that there are a series of arrangements that the tax office is aware of, and they have concluded that in the absence of changing Part 4A, they might not be able to secure the tax that they're looking to secure. The last piece, apropos of international tax integrity, well, actually, it's not the last piece, there's one more after this, but we were to introduce a patent box regime, which was to provide a significantly lower rate of tax for companies that focused solely on generation of patents. That would have been really good for our bioscience industry. It was announced, not introduced, but scrapped before it got introduced. The next slide, please. This last slide, we don't have a lot of detail on, but to put it into context, the OECD has sponsored what they call base erosion and profit shifting, and they've been looking at arrangements to deal with these arrangements across a multiple number of years and across all jurisdictions. It grew out of it, the increased digitization of the economy and ensuring that all companies paid their fair share of tax in the jurisdictions in which they operated. This latest change is effectively to implement a domestic minimum tax so that there will be on all companies that operate, or all multinationals that operate in Australia, that there will be an effective minimum tax rate of 15% on everything that on all revenues generated out of Australia. Next slide, please. The interesting, we're a little light on detail on this, but one of the things that was interesting in the budget papers, as you'll note there, I've put down what the expected revenue to be raised from these measures will be over the next 4 years. And I think it's fair to say that they are extremely modest amounts of money, and one might suggest that a sledgehammer is being used to crack a peanut, but nonetheless. Next slide, please. And this might be the last piece that involves multinationals. There were two changes for the petroleum industry. One that's mentioned here, which is that they're restricting what might be regarded as exploration expenditure. There was a court case where Shell argued that exploration expenditure included doing a feasibility studies or feasibility assessments on the economic viability of a particular resource. This change is to ensure that feasibility studies are not included in the assessment of what is exploration, although I don't expect that there's that many people joining this webinar for whom this will be an issue. The last piece of change for the petroleum industry is there was a fair amount made of a change for the gas industry, the Petroleum Rent Resources Tax, the PRRT, to limit the amount of costs that they can claim against their revenue from 100% down to 90%. And that was designed to reduce, well, certainly increase the amount of revenue from the gas industry. I think it's also fair to say that the PRRT probably applies to fewer than a dozen companies in the country, and I'm not entirely sure that anyone on this webinar is one of those companies. I said one of the themes was producing policies or designing measures that didn't seem to fit in with an overall budget approach. And to me, this build to rent and clean energy buildings measures falls into that category. So focusing on the build to rent sector, the idea was that capital works deductions, which currently run at 2.5%, would be increased to 4%, providing an incentive for people to get into the build to rent housing construction sector. For those where you had foreign investors, which is what the MIT regime is in relation to, that the withholding tax on payments made out of the MITs would be reduced from 30% to 15%, with the notion that foreign capital would be attracted to investing in this sector, therefore dealing with the population growth that Ellie referred to and housing affordability, which we hear about on a regular basis. The requirements or the parameters to get into these benefits is that it requires a minimum 10-year holding period. It requires that the landlords provide minimum lease terms of 3 years. My personal view is that these measures are unlikely to generate the sort of capital that the government would like to see moving into this sector, simply because the constraints, the 10-year constraint, the need of foreign capital to generate significant returns, and returns of in excess of 10% are unlikely to be generated out of these schemes, simply because of the holding period term, that rentals generally don't generate high rates of return. So I think that there, in theory, this is a great idea, but in practice, I'm sorry, but I can't see that producing all that much. Next slide, please. So yes, will it achieve the desired housing outcome? I think not. How does it interact with other government policies like a population policy? Where is that population going to live? Is it going to be in cities or in regions? I don't think that measures like this can sit as standalones. I think they have to sit in the context of broader policy decisions, and the government and governments of all persuasions, to be brutally frank, really don't put these measures in the context of broader policy direction, and I think that that consigns them to being less likely to succeed. Last couple of changes for corporates. The instant asset write-off is being extended for 1 year, so that you can take an immediate deduction of $20,000 for acquisitions of assets of up to $20,000. Unfortunately, this is restricted to only small businesses, so those that having less than $10 million turnover. Up until 30 June this year, that was available for companies that had up to 5 billion worth of turnover. So this is a significant constriction in an incentive that's been around for some time. But that said, making sure that small businesses are able to access or continue to access this type of benefit needs to be given a pat on the back. There's also an additional deduction of 20% for electrification and energy efficient expenditure, where companies invest in energy saving technology. And yes, it probably does also include having a 6-star rated fridge. SMEs up to having turnover of up to $50 million will be able to access this. The maximum eligible expenditure is $100,000, producing a $20,000 maximum tax deduction. It applies to expenditure that happens from July of this year through to June of next year. If the expenditure is on something that for which there is an immediate tax deduction, then that extra 20% appears to be available in that year. Where the expenditure doesn't qualify for the immediate deduction, but rather is a depreciable, then it's expected the additional 20% deduction will be allowable over time. I said early on that the governments of all persuasions continued to invest in ATO task forces, and this year is no different. There's a serious crime task force and a serious organised crime task force that is getting an additional $256 million worth of funding. Typically, these types of task forces generate multi-times the amount of money that's invested in them. And in all seriousness, these measures are probably far more productive than anything that was in the previous 10 slides. The GST compliance program is exactly the same. I think it's very interesting to note that that's getting at least double the funding that the serious crime task force is. So one ought to assume that there is an assumption inside the tax office that a GST compliance program will generate an enormous amount of revenue. So I think the takeaway from this, if you're in serious organised crime, you've got a different series of takeaways. But for GST, I think a prudential review of your GST arrangements would be highly valuable. Personal income tax compliance is only getting an extra $91 million worth of funding, but as I said at the start, they don't fund things that don't generate multiple times returns. So with all that now dealt with, I'll now pass over to James Traynor, who's going to take you through the delights of the impacts on individuals. James.
Thanks very much, David. Well, on behalf of Dr. Chalmers, let me pass on a massive thank you to all the individual taxpayers out there. You've certainly done your bit to help the government achieve a budget surplus, and the first budget surplus in approximately 15 years. So well done. So how have we all done that? Well, we've worked really hard. Unemployment has been at 50-year low rates. So there's been more people who are working and paying taxes. There's been some modest wages growth. And whilst the wages growth might have been less than what the inflation rate was, thanks to the scourge of tax bracket creep, any nominal wages growth sees more individuals get pushed into higher tax brackets. So the government gets more money from the extra work that is being done. And finally, with more people in work, it also means that the government has to pay out less in terms of welfare. So there are lower social security payments. So all of these things put together have been a real plus to the government and really helped them achieve the budget surplus this year. So thanks, everyone. So what's the government done to reward all of us individuals who have really helped the government achieve that budget surplus? Well, don't hold your breath. There's not a cash handout for a really broad range of individual taxpayers. Rather, the government has been far more targeted in the relief that it's providing to the individuals. And it's been done under this umbrella of cost of living relief measures. And there's a few measures that are referenced here on this slide. And the common theme around them is that they are really targeted at those in the community that really need support. It's not a broad brush approach. So some of the examples that we saw on budget night was energy bill relief. And so this is where the government is providing up to $500 for individuals who are receiving some form of government support to help manage the increased costs of energy. And interestingly, this will be delivered not as a cash payment to the individual, but rather it will be in the form of a payment through to the energy retailer. And so what we'll find here is that one size does not fit all. The amount that is available to individuals will depend on where you live and a range of other factors. It was touched on earlier around housing affordability being a real challenge across our community. And I would echo the sentiments that David was saying, that this is really an opportunity lost for the government here. A little bit of tinkering to help those who require rent assistance. So there's an increase in rent assistance. So that's more money to individuals to help them fund their rent, but it's really not taking away the rent crisis that many of those individuals are facing. There's also been an expansion of the home guarantee scheme eligibility. Now this scheme is where the government steps in and guarantees loans, and mainly targeted at first home buyers. And it allows those individuals to acquire a loan with a deposit of around 5% and avoid having to get mortgage lenders insurance. So the eligibility has been expanded to include not just a spouse or a de facto, but family and friends who can go in with the individual and purchase their first home. There's been a change to the single parent payment recipients. And so this raises the cutoff age from 8 to 14 years. And the government expects that this will impact about 50,000 single mothers. So again, part of a theme of the government to focus the cost of living relief measures at those who are most in need. Health featured very prominently in the budget. And in relation to individuals, it's around pharmacy scripts was one of the things that has changed. So it's increasing the eligibility for prescriptions from 30 days to 60 days supply. And what that means is that there's less need to go to a doctor to get a prescription and less need to attend the chemist, and that should hopefully help reduce the cost of medicines. Childcare was included in this budget, not as a new measure, but just because it was announced previously and we're seeing the flow on into the budget numbers. So just a reminder there that the childcare subsidy has been lifted to 90% of the actual cost for families with a combined income of 80,000 or less. And then it tapers out as the family income increases until it reduces to nil for family incomes above 530,000. So again, that measure is really targeting the females and encouraging more females to return to the workforce. Finally, we see a change to job seeker and an increase, a modest increase in the amount of the fortnightly payment by $40, but no doubt that will be very welcomed by those individuals who are relying on that payment for managing their costs. There's also a change to the rate. So there is a higher job seeker rate for older Australians. The government is reducing the threshold when that rate applies from 60 down to 55 years. So for those of you that have been following along very keenly, I can hear you saying, hang on, you're a tax partner. Where are the tax changes for individuals? And it's taken me to my third slide to talk about taxation for individuals because really there's not too much to talk about. So on budget night, we saw, as expected, no change to income tax rates for the 23-24 year. However, we do have the stage 3 tax cuts, which were announced back in 2018, which are due to become effective on the 1st of July 2024. And this is a measure that will certainly deliver tax savings to a broad range of individual taxpayers. And as you can see in the table there, what will result is that there will be a really large middle tax bracket. And so what the government expects is that most individuals will be paying no more than 30% tax because that tax band will apply from income of 45,000 all the way up to 200,000. So tax savings across a broad range of tax categories there. But as often pointed out, that is likely to favour those who are on higher incomes. They'll get the lion's share of the benefit. There was one change on budget night, and that's to the Medicare levy, and that's an increase of the low income threshold, and that'll be effective from the 1st of July 2022. And again, that's one of the measures that's targeting the cost of living challenges for those on lower incomes. So turning now to employers, one of the big announcements that happened, not on budget night, but a little bit before budget night, was changes to the way that superannuation is paid by employers. So at the moment, employers don't have to pay their superannuation until the end of the quarter, so by the 28th day following the end of the quarter, so 4 times a year. What the government is looking to introduce is a measure whereby superannuation is paid at the same time that salary is paid to the individual. Now, this is going to involve a fairly significant change, and so to give employers enough time, this measure is not due to come into effect until the 1st of July 2026. And what was happening here is the government's concerned that many employers were actually using the superannuation entitlements as working capital. And then for some of those organisations that actually went bust, they weren't able to then use those funds to pay the super contribution, so employees were missing out. So that's the mischief that the government's looking to target. This will involve significant administrative changes for employers, and also it involves quite substantial changes to the way the Super Guarantee Administration Act works. And I guess some of the challenges for employers arise from the fact that, well, while theoretically it doesn't sound like much of a change, superannuation applies to more than just employees. It also applies to certain sole trader contractors. So employers will need to work out in real time who their employees are. They'll also need to work out things like which super fund to make contributions to. So at the moment, if you pay it into a super fund that's not the right super fund, the employer can be penalised for that. And so if you're bringing a new employee on board, it doesn't give you much time to find out the right super fund to make the contributions into, before the first pay period comes up. There's also the challenges of working out what is ordinary time earnings. So again, the salary that's paid to an individual, maybe not all of that is ordinary time earnings. So the contribution, of course, for superannuation is based on ordinary times earnings. So there's a little bit of an effort there that employers will need to go through to make sure that they're picking up the right amount. Anyone who works in payroll will tell you that there are constantly adjustments to payroll. So someone doesn't put in a leave form, so they're overpaid, but that's kind of picked up in the next period. That'll be much harder unless there is some sort of change, because once amounts are paid in superannuation, it's really difficult for employers to get those funds back from the super fund. So that'll be a challenge. And also around late payments. So the way the rules work at the moment is that there is a late payment by even 1 day, employers are subject to fairly draconian penalties. So given we're talking about a frequency of payment potentially 52 times a year, we're hoping that there will be some changes in the legislation to allow a more flexible approach. And so hence we look forward to the consultation in that part so that employers can be well prepared for the changes that are coming in 2026. That's it for me on individuals employers, and I'll now happily hand over to Shirley.
Thanks, James. And it was a nice segue into the superannuation section, which is the last section for today's webinar. So my tagline for the budget was that super's extra taxes will help pay for the budget, but perhaps not just yet. It's about 4 years away, I think, before we see any of this change coming through. There's really only 2 measures that I'm going to touch on today, because there wasn't a lot, and in fact there wasn't even a lot of new stuff. It was really just reinforcing it. The $3 million soft cap on superannuation benefits is here to stay, and we'll probably spend most of our time talking about that one. And then lastly, I'm going to just talk about some non-arm's length transaction tax rules, which are a bit technical and probably apply more to the accountants on the webinar than others, but we'll touch on it nonetheless. So the $3 million cap, make no mistake folks, it's a wealth tax. So it's by putting it in the budget, the government has absolutely confirmed its commitment to limiting tax concessions that are available to larger superannuation balances. And the government's definition of a large superannuation balance is obviously $3 million. We already have restrictions in terms of how much of our superannuation can be in pension phase. We've got our transfer balance caps that started at 1.6 million, have gone to 1.7, and of course are now going to 1.9 at the 1st of July. So it's certainly something we need to look at. Although the message we would say is don't panic at this point in time. There's still a lot of things to be worked out with this $3 million cap. And I will take you through an example of how we think the rules apply at the moment based on what's out there. But there's still a lot of water to go under this bridge. So it does apply only to those individuals who have a total superannuation balance of more than $3 million. Now, your total super balance is across all of your superannuation funds, not just on a fund-by-fund basis. And basically what they're doing is they're saying that if your fund balance, your total super balance, increases during the course of a year, then they're going to tax that increased revenue as a proportion of your total at an additional 15%. Although the exact percentage, of course, will depend on what's included in that earnings figure. So certainly, we need to look at what is included, and we'll do that. What they're saying is the headline rate is 30% for tax on high super balances. And while that does seem high, it is better than the top marginal tax rate. And of course, if investments were held externally or personally, then potentially earnings would be taxed at a much higher rate anyway. The start date for the mechanism is from 1 July 2025, being the point in time where we, I suppose, put the stake in the ground as to what your total super balance is. So the first year that it will be measured is at 30th of June 2026, and it will be the growth in that year for year one. And then tax, of course, will be assessed after that, and obviously won't be paid until the 26-27 financial year. So there's 4 years until we're going to have to be paying tax, and certainly several years before we need to work out what to do. As I said, our position really is wait and see. There are obviously some things that we can do to help clients manage the implication of this. But until we know exactly how it works, we wouldn't be rushing to make recommendations. So let's have a look at how we think the tax works and crunch some numbers, because people always like to see numbers in my world anyway. So this is a very simplified example, and it's not meant to, there's many complications that will come, but on the simplified example, if you started with a total super balance of $4 million and it grew to $4.5 million, the earnings figure that the government is talking about is that growth in the balance of your account of $500,000. Only the proportion of those earnings that is effectively above the $3 million threshold is the bit that is going to be the taxable earnings at this additional tax. So basically a third of the member's total super balance is above the $3 million threshold. So a third of that $500,000 is what is taxed at the 15%. So crunching those numbers, it comes in at a tax bill of $25,000. But there's lots that we need to think about in terms of what is included. So that growth component includes earnings, so that's net earnings, so all income, dividends, rents, whatever it might be. It includes capital gains, so if you've sold assets, you've realised capital gains. It includes unrealised gains, so that's any increase in the market value of your investments inside your super funds. And that's quite controversial for our clients. It's the first time anyone has tried taxing unrealised gains, and certainly, this has been a measure that has engendered lots of discussion, lots of submissions, and will continue to do so until we get some clarity around this. It also includes tax refunds. So what it doesn't include are contributions to super or benefit payments. So the growth factor or the earnings amount will be adjusted for both pension benefits, benefits or withdrawals, and for contributions. So as I said, this unrealised gains and tax refunds being included has caused some controversy, and we will see significant submission on this before it is settled. But where we'll wind up, we won't actually know. The last topic for today is this non-arm's length expenditure. So non-arm's length income, as I said, it's quite technical. Probably the accountants in the room will understand it a lot more. But certainly non-arm's length income is income that is being generated essentially from non-commercial transactions. And non-arm's length income in superannuation land is taxed at 45%. Back in 2018, the legislation was changed so that now non-arm's length expenditure could also lead to non-arm's length income and a tax rate of 45%. So again, this is around where expenditure that is incurred by a superannuation fund is less than a normal commercial transaction or not incurred at all where it should be. So it's income that is attached to that expenditure, that has a nexus to it, that is being taxed at 45%. Again, this caused significant discussion. There were significant submissions made, and I suspect the superannuation industry, certainly the SMSF sector, still doesn't think this is a settled question. The budget did show some relief by limiting the amount of income that can be classified as non-arm's length income to twice the amount of the expenditure, although it wasn't clear whether that was twice the actual or whether it was twice what it should be or whether it was twice the bit that's missing in the middle. So again, we've still got some clarity around that. Two other points that came out of this was that contributions are not included in non-arm's length income, and neither they should be. But lastly, and what is certainly disappointing from an industry perspective, is that this measure only applies, this non-arm's length expenditure measure only applies to SMSFs and small APRA funds. It doesn't apply to any of the large APRA regulated funds, which does show a differentiation of tax positions depending on whether you're in a large fund or a small fund, which is, we don't understand why there has been that differentiation. Super is super, it doesn't matter the size of the vehicle in which it is in. So I'm sure we've got plenty of time for questions, so I'm going to pass back now to Jason, and he can take us through what questions you might have come up with throughout the course of this morning's presentation.
Thanks, Shirley. And actually, the first question that's come through is for you, so I'll ask you to address this one, please. It is on the $3 million super cap, and the question is, what happens if my total super balance falls below $3 million?
And that's a good question. Again, we don't have a lot of clarity around some of this stuff, so we are still waiting and seeing exactly. What we think will happen is that obviously if you fall below the $3 million cap, then in that year there will be no additional tax. The problem is we don't actually think you're going to get a refund of tax you've already paid either. We think you might be able to carry forward that reduction like it was a loss and apply it when there are future gains. So trying not to double up on that. But again, without that clarity around what exactly is happening, it's a little bit of, you know, Shirley's best interpretation of what the government thinks they want to do.
Thank you. David, a question for you, please. For the multinational tax changes that you spoke about, is the low tax rate jurisdiction assessed on the jurisdiction's headline tax rate or the effective tax rate?
Well, it's really a bit of both, but because your effective tax rate will be a function of what the jurisdictional rate is in any event. It is expected that it will be a calculation, and we don't know yet what's included or not included in that calculation. For example, concessional depreciation and all those sorts of things. What I will say though is that it's instructive that the Irish are about to increase their tax rate from 12% to 15%, because I think the Irish wish to retain all the benefits or all the economic benefits of sitting in the middle of Google's structures. So I think you will find that there will be enormous, those countries that have a tax rate that hovers a little under 15% will increase it to 15%. be interesting to see if the Cayman's response is the same. But so the answer to the question is it's a bit of both.
Thank you. A question for you, James. Do you think the government will defer the stage 3 income tax cuts due to start next year?
That's a really interesting question. My personal view is I don't think they will. And the reason why I say that is that the government has had lots of opportunities since it came to power through COVID to make that change, and they're I think would have been perhaps better grounds for making that change. And they've consistently said that it's not part of on their agenda to defer those tax changes. So I expect we'll still see them come through. As I mentioned in my presentation, individuals have been really supporting government. There's far more of us in work, so I think that there is a sense that those broad range of individuals need to be rewarded in some way. But what I do think is, given the challenges that the budget will have over the coming years, we probably won't see much in the way of other concessions for individuals. This will be it. So enjoy it while it lasts.
Always good advice. Thank you, James. Ali, a question for you. This is the first time in quite some time that the budget has resulted in a surplus. In your opinion, does that mean that the budget is in great shape?
So while it is good news that the government has predicted that $4 billion surplus for this year, and that's, I think, the first since 2008, this is due more to things like higher commodity prices and strong employment growth rather than any specific government intervention. So the bad news is that, in terms of structural deficits, the budget is going to be back in the red in the following few years past this financial year. And future revenue is probably unlikely to be enough to cover the expenditure, particularly given the well-publicised demands on the budget from defence and healthcare and the NDIS. So that is going to be something that's of concern going out in the next few years. So probably not all good news, but good news just for this year.
Excellent, thank you. Shirley, a couple of questions for you on superannuation. Firstly, does the total super balance refer purely to an individual's super balance, or do spouse balances get included within that? And the second part of that question, if there's a total super balance of say $4 million, is it only the additional 1 million over the cap that's subject to additional tax, or is it the entire balance?
So a couple of points there. It is an individual measure. So it is an individual's personal total super balance. So that won't include spouse accounts or spouse balances. It's not a family tax, it's an individual tax. And it's taxed a little bit like what is currently Division 293 taxes or excess taxes. It's applied personally. In terms of what's actually taxed, it's not the bit above 3 million that's taxed, it's the earnings in any given year if you are above $3 million. So the example we had growth in the balances or earnings of $500,000. That is then, you only take the proportion of that where the account balance is above. So it was 4.5, 1.5 above the 3 million, which makes it a third. So a third of the 500,000 at the 15% tax. That is so, and let me just put a rider on that. That's our interpretation of how it works. Until we see the exact nature, but that's the interpretation we have at the moment.
Terrific, thank you. And David, one final question for you, if that's okay. Could you comment briefly on the application of the new frank distributions rules regarding capital raisings?
Yes and no, I can comment on that. It's currently, as I understand it, it's currently in Senate committee. So I can't comment to the extent that I know what the rules are going to be. But the notion was that any dividends funded by capital raisings would lose the benefit of franking. I know that there was a fair amount of pushback from a whole range of segments, thus the reason that it's in Senate committee. So at this point in time, I'm unable to provide anything definitive other than to say it definitely is in the Senate subcommittee.
Terrific, thank you. So we've reached the end of the webinar. I'd like to take this opportunity to thank all of our panelists today. They did an excellent job in unpacking a very full and detailed budget, albeit absent some of the structural changes that I think we would all welcome. Before we wrap up today, we'd really love your feedback, and you'll have the opportunity to provide us with your thoughts after the webinar closes. We would really appreciate you taking some time to do that. Don't forget to check out BDO's federal budget report available on our website. Thank you again for listening in, and have a great day.